So a popular fund is, of course, Scottish Mortgage Investment Trust in people's pensions. I have several problems with that. First of all, I've written in my Financial Times columns in the past and in my books, you can see them over my shoulder, that people tend to pick funds based on name recognition. And if a fund does well one year, there's next to no correlation to doing well the next year, which suggests that it's more luck. If you don't take my word for it. Actually, Eugene Fama got a Nobel Prize in economics a few years ago for showing that. Okay, so let's look at my problems with Scottish Mortgage Investment Trust, which was once regarded as a darling, so people held on too long. They rode it when the tide was rising, and then when the tide went out, they saw that actually it was swimming with no clothes on, and it couldn't deliver results. Let's see how it's done over the last 3 years. Well, over the last 3 years, they've pretty much lost between a third to half your money. Well, wait a minute. 2021, the markets were skyrocketing. 2023, the Nasdaq alone was up 55%, and the S&P 500 was up 25%. And you might say, oh, no, of course they're not relevant. Well, they are relevant because those are the stocks that it's picked, and I'll show you where it's even managed to get it wrong. And sadly, and you might not know what the difference between this pink line and this blue line is, but it's incredibly, incredibly important. Now, let me zoom in there. Sadly, even in terms of what they own, their share price doesn't reflect it. That's called a discount. And the market often gives a discount on what somebody owns. So if you own the same stocks they owned, you'd actually be worth more than the fact that they're owning it. The market's discounting it. In other words, it's the market sort of saying, yeah, I know they've got these stocks and they're worth this on their books, but it's this bunch of muppets, so we're going to discount it. And the thing investment trusts hate is a big discount, to the extent you can often have the board of directors fire the people who are managing the money. Okay, and that can be worrying. So this is the discount. The discount can sometimes be 20%. So get this, the fund might own £100 worth of stocks, let's say, but the market is only putting a value of £80 on it. Even though it's £100, if you bought the same stock for £100, it would be £100 in your portfolio. But because you bought it through this investment trust, the market's saying we're going to price it at 80. So you're getting double screwed as well. Let's look at their performance. So over 3 years, it says 33%. I think it's closer to 50, mate. So what do they own? Well, actually, what they own, some of it's not bad. I did last year own Nvidia, still own Amazon. Mercado Libre, if I remember rightly, isn't too bad. Moderna isn't too bad. I had Tesla for much of last year. The problem here seems to be, partly in terms of what they're holding, but partly seems to be that when they are holding something, they're not really holding much of it. Now, you might want to cherry pick 15 of the 20 best stocks out of, say, 10,000 if you know how to select stocks based on ticking a value, growth, income box. It doesn't take much effort. Actually, it's like learning to drive. It's not that difficult once you've got the data. But the problem here is they're not giving you that. If you think to own Amazon, you need to go through them or Nvidia or to own Tesla, you're wrong, because you can just do it directly. And in fact, getting it through a fund, as I've shown, means you're getting less value than you should if you just bought it directly, which is ridiculous, let alone that you're paying the fund that privilege as well in fees. So you're really getting screwed on many grounds. And I say, not only performance. So why has it done so poorly over the last 3 years? Well, one of the reasons is in 2022, when the market fell, it couldn't go into cash like sensible people such as myself would, or private investors could. That's one reason. And that happens once every 6 years, but it's like snakes and ladders. There's no point in climbing the ladder for 5 years if in the 6th year you go back to zero. And that's common with funds. For 5 years, they'll market like crazy because by chance they've picked Nvidia or Amazon, they've done well, and then it'll collapse. And they know most people won't compare them to, say, a Nasdaq, which has gone up 55%. They'll just compare them to a bank account. It's just how humans are. And they'll go by name recognition. And then at the end, the humans will go, what else was I going to do? It's too late now. I'll just stick with it. I can't find the forms anyway. Those are all the reasons why your pension ends up sucking, I'm afraid. But there is an alternative way, which is you just take a bit more interest in your own pension and be more proactive. Just as I should be more proactive with my health and take a bit more interest in my health and, go to the gym once a week. So a little effort is actually worth it, and hopefully people will do it, because I don't want to get punched in the face economically in my pension by having something like this in there, I'm afraid. Okay, hopefully that helps a little bit in explaining, well, why people's pensions suck.